Hello and good afternoon to everyone that is currently tuned in live with us on another episode of Phillip Trading Podcast. I'm your host for today, and my name is Yongxian. With me here today is my colleague Liao, a dealer and marketing executive from Phillip Capital. How are you today, Liao?
Oh, I'm fine, thank you.
Okay, great. So for today's podcast, we will be discussing on the topic easing rate hot inflation data and what does it mean to the market. Once again, I would like to help all of you, our beloved audience today, to share this video to all of your friends. The more people that are watching this video, the more we are motivated to deliver greater content to all of you. And without further ado, let's jump into our topic for today. US annual CPI data came in at 8.5% below market forecast of 8.7%. Stocks market rose up with S&P 500 hit its highest level in 3 months. The Federal Reserve will also be weighing the inflation report along with other key economic data ahead of its September meeting. So my first question to you, Liao, can you briefly tell us the current macro environment as well as the newly released CPI data?
Okay, yes. Thank you for the question. So let's talk about the CPI data first. So recently, the CPI data or the inflation data has been released by the US, which was seen at the 8.5% on a year-on-year basis. So this is lower than the inflation rate back in June, which was at as high as 9.1%. Now, if you look at the core CPI data, which excludes the volatile food and energy components in the calculation, the core CPI remained firm, climbing at an annual rate of 5.9% in line with June's figure. And the drop in the inflation data was mainly due to the drop in gasoline prices for over more than 50 continuous days, and it provided some relief to the US consumers last month. And so far, the gasoline index fell 7.7%, whereas the energy prices fell about 4.6%. Now, in terms of the macro environment, the easing of overall inflation coupled with strong labor market conditions could provide some optimism to the Federal Reserve that the rate hikes are working and that a soft landing is possible by bringing inflation down without sending the labor market tumbling. And following the release of the new CPI data, markets reacted positively with all three US major indexes increase going up, with the hope that the cooling down of inflation would prompt the Federal Reserve to scale back the magnitude of the interest rate increase in September. Oh, and on the other hand, the US workers' hourly wage has also increased 0.5% in July and 5.2% on a year-to-year basis. Now, although there's a cooling off for the inflation temporarily, the pressure is still remains strong across other components, and the declining gas and energy prices were offset by the increase in the food and shelter indexes.
Okay. So with all the increase, has actually the CPI data reached a peak, and are we looking at a cooling economy?
Well, there are a few indicators that could points to the direction of the inflation data. If we look at the Baltic Dry Index, they are now back to the level in early February, whereas for energy index and crude oil is now back down to the $90 level, which is about a 6-month low level. However, natural gas remain elevated, and so the CPI data might comes in lower in September. However, it is still not safe to say that we are at a cooling economy. And despite the US is in a technical recession, their GDP has contracted for 2 quarters in a row, but the unemployment rate is also low. And corporate earnings have come in strong this summer. And in addition, we should wait for the National Bureau of Economic Research to officially declare that we are in a recession. Okay. And given the strong job growth in the US economy is probably not in a recession. Over 500,000 payrolls were added in July on top of 2.8 million in the first half of the year. The increase in hiring despite recession talk and worker shortages, fully erase the 22 million jobs that were lost at the start of the pandemic. So all in all, there's not enough relief in sight for inflation just yet, and certainly not enough for the Fed to back off anytime soon. And in fact, even with a sharp retreat in gasoline prices in July, we are still looking for headline inflation to hold close to 9% year over year in the summer.
Okay, so with all this happening recently, what do you suggest, or what should the traders look out for after the new CPI data is released?
Okay, so after the CPI data is released, traders should continue to keep an eye on the CPI data, of course, and as well as the 2-year and 10-year bond yield. Because when we are seeing an inverted yield between the 2-year and the 10-year bond yield, it is often an indication of a possible retreat in the stock market. So yeah, despite seeing an easing inflation data, we should keep in mind that the Fed targeted inflation rate is 2%, and we are still seeing about 3 to 4 times higher inflation rate. So therefore, the high CPI data will still be a problem for the Federal Reserve, and the magnitude of rising rate might stay in between 0.5% to 0.75%. When we start to see the Fed is decreasing interest rate, it might be an indication that the market will have a very huge downfall.
Okay, great. So, like with all the CPI data, all the inflation, right? So, what do you suggest, and what is your view on the market for the rest of the 2022, as we also left about 5 months till 2023?
Okay, so yeah, economic uncertainty may have peaked in the first half of this year, but it is still remain high. Stocks are likely to continue to feel the weight of the Federal Reserve policy tightening, and we should expect to see a continuing shrinking market liquidity and a slower economic growth. And the sharp rallies within an underlying downward trend are typical of bear markets. So investors should be prepared for more volatility moving forward. We are also expecting to see a weakening earnings, weakening corporate earnings, and profit margin outlooks could prompt another leg down for the market. And in the meantime, this is not a market likely to reward excessive risk-taking. So in conclusion, economic uncertainty may have peaked in the first half, but it could still contribute to volatility and affect market performance for the remaining of this year, 2022.
Okay, great. So I hope that with all the US data and also for our side in Malaysia, hope everything goes well until next year. So yeah, thank you, Liao, for the very insightful information that you share with us today. So thank you all for tuning in with us. So if you have any further question with us, or if you would like to know more anything about the products that we are offering, kindly feel free to contact us. And that's all for today. Thank you, everyone. Bye bye.
Thank you. Bye-bye.